Right now, everyone's glued to headlines about market corrections. There's a huge opportunity playing out right under our noses. And honestly, most investors are completely missing it. While some people are panicking, a much smarter, quieter game is being played. So let's dive in and see what's really going on here. It really boils down to this one simple question. When the market takes a nosedive and you see retail investors rushing for the exits, the pros, the smart money, they're not panicking. Nope. They're pulling out their notepads and making a plan. So what's their secret? What do they know that the rest of us don't? Well, that's exactly what we're going to unpack today. The biggest clue is actually hiding in plain sight. We're not talking about some obscure, risky stocks here. We're talking about India's most trusted blue-chip companies, the giants of the Nifty 50. A lot of them are trading way below their recent peaks. And trust me, this isn't just random market noise. It's a signal, a big one. To really get what these signals mean, we have to decode them, almost like breaking down a secret message, layer by layer. So we're going to break these corrections into what I call drop zones. Each zone tells a completely different story about what the big institutional investors are thinking, and, more importantly, what they're doing. All right, let's start at the top. Zone 1, a drop of less than 10%. I like to call this the confidence zone. It's just a minor dip, a healthy little pullback. A drop this small shows that the big money's faith in these companies is still rock solid. And just look at the names in this zone. We've got Nestle, Titan, Apollo Hospitals. These are absolute leaders in their fields. The fact that they've barely corrected tells you everything. Smart money is holding on tight. No panic here, just pure, unshaken confidence. Okay, let's move a little deeper. When we start seeing drops between 10 and 15%, we've just entered the uncertainty zone. This is where the ground starts to feel a little less solid under your feet, and that easy confidence, it starts to fade a bit. And who do we find here? Giants, Tata Steel, SBI, even Reliance. These companies are basically pillars of the Indian economy. When they start to wobble by this much, it's a huge sign that a general feeling of uncertainty is beginning to spread through the entire market. It's not a five-alarm fire, but it's definitely a warning sign. Now, this is where it gets really, really interesting. Welcome to the adjustment zone, which is a correction between 15 and 20%. At this point, the pros stop just watching from the sidelines. They start making some serious moves and adjusting their portfolios for what they think is coming next. So when you see absolute behemoths like ICICI Bank, Bajaj Finserv, and Airtel falling this much, that's a massive tell. This isn't just your average investor selling off a few shares. This is big institutional money reevaluating everything and repositioning their chess pieces. The pros are officially in the game. Going deeper, now we hit the 20 to 25% drop, and we call this the fear zone. The name really says it all. At this point, the bad news is everywhere. Doubt is spreading like wildfire, and for a lot of investors, raw gut emotion is now in the driver's seat. And in this zone, you'll find household names: Cipla, L&T, Hindustan Unilever. When companies that are this stable, this well-known, fall by almost a quarter of their value, that's when retail investors really start to hit the panic button, thinking it's all over. Logic goes out the window, and fear takes over. And finally, we get to the deepest level, a drop of more than 25%. This is what we call the shock zone. A correction this bad in major blue-chip stocks isn't just about the stock anymore. It's a signal that there's a much bigger, sector-wide problem brewing. The perfect example of this right now is the entire IT sector. TCS, Infosys, Wipro, the big three, they're all down more than 25%. When you see a whole industry get hit this hard, it's pointing to major economic shifts. Maybe a global slowdown, maybe lower demand. Whatever it is, it's a flashing red light for the whole economy. So we've seen what's happening across these zones. But now we have to ask the most important question of all. Why? How does smart money read all these signals? What's their playbook when everybody else is running for the hills? So the pros basically see two possible scenarios. The bull case is thinking, wow, these fantastic companies are on sale. This is an incredible long-term buying opportunity. So they start to slowly, carefully buy up high-quality stocks at these discounted prices. But there's also the bear case, which says, yeah, they're cheap, but what if their earnings don't recover? They could get even cheaper. It's a calculated risk, and they're weighing both sides. This one line perfectly captures the entire philosophy. It's so simple, yet so powerful. When fear is peaking and retail investors are dumping their shares just to stop the pain, smart money sees an opportunity. They understand that the best deals are always found at the point of maximum pessimism. They are, quite literally, buying the fear that everyone else is selling. Okay, so understanding the theory is great, but how do you actually use this stuff? Let's translate this professional mindset into a clear, actionable strategy, a game plan that you can actually follow. Here it is, the four-part rulebook. First, observe support. Don't try to catch a falling knife. Wait for the price to stop dropping and find a stable floor. Second, check the volumes. If you see more and more people selling as the price goes down, that's a red flag. Be careful. Third, and this is absolutely critical, focus on quality. You're trying to buy great companies that are temporarily on sale, not bad companies that are just cheap for a reason. And finally, use structure, not emotion. You need to have a plan before the market starts to fall, and then you have to have the discipline to stick to it. And just remember this: a market correction is normal. It's healthy. It doesn't destroy wealth over the long term. What really destroys wealth are the bad, knee-jerk, emotional decisions that people make during the correction. Having a plan is what protects you from yourself. So if we were to boil everything we've talked about down to one single powerful idea, what would it be? Well, it's a principle that's incredibly simple to understand, but man, it is so hard to actually practice. That's it. Plain and simple. Investing, especially when things look grim, is not a race. It's a waiting game. The market doesn't care who reacts the fastest. It rewards the people who have the patience to wait for the right price on the right company at exactly the right time. I want to leave you with this one final thought. By their very definition, the best investment opportunities always feel scary. They always pop up when the news is terrible and the future looks completely uncertain. Think about it. If buying felt comfortable and safe, the opportunity would already be gone. So as we wrap this up, just know the market is constantly sending out clues. Now that you know how to look for them, the only question left is, are you prepared to read them and act with a plan? Hey, if you found this breakdown helpful, make sure you subscribe. We put out more explainers just like this, all designed to help you understand the market and become a smarter investor. And of course, a very quick but important disclaimer. All the content here is for educational purposes only. It should not be taken as investment advice. The host is not a SEBI-registered advisor, so please always consult with a qualified financial advisor before making any of your investment decisions.